Welcome back to the channel, you beautiful people. I hope you're all doing great. Today's video is a request from a friend who wants to know how to start investing. So because of that, I am going to do a full breakdown of the entire journey from opening a brokerage account to growing wealth. So disclosure, I am not a licensed professional. Please do your own research first and contact your financial advisor if you have one. Let's get into it. So before I talk about how to start investing, I first want to address some of the most common fears and questions that I hear about investing itself. So one of the most common concerns that I hear, it's really a complaint. When I ask, why don't you invest? The most common answer that I get is, I don't have enough money to invest in the market. Now, it's funny when I hear this because there are three reasons why I feel people would say this. One, they're just scared of the market. They are afraid of losing money. They're afraid that they're gonna miss something. They're afraid that they're not gonna make as much money as everyone else. Whatever it is, it's something to do with that they are scared to invest. Second reason why they would say this is that the investing is not a priority for them. And three, they think that they need a lot of money to invest in the market itself. And because this is such a common question, I really want to put this question to rest. So to get this fear under control of, I don't have enough money to invest, nowadays with the apps that we have and the explosion of retail investors that are popping up all over the world, there are now brokerages that allow investors to start with as little as $1. And if you cannot afford to put $1 in the stock market, then you're not concerned about the cost of investing. You're just scared of investing itself. And this leads into the next common issue is that people are scared of losing money in the stock market. That is one of the reasons that they don't, is that, oh, hey, I'm going to put in money and it's just going to go down automatically. And that is true to a certain extent. I have had it happen before where I bought a stock and seconds later, I'm already in the red. And for those who are interested in day trading, then yes, there is a very large concern where if you put in money into the stock market, you very well could already be in the red and losing money. However, if you are a long-term investor, then investing into an ETF of the S&P 500, real estate ETFs, value stock ETFs, all of these ETFs over the long term, you are almost guaranteed of making money. Okay, the stock market on average, the S&P 500 on average has an average return of 7%. What this means is that on average, if you hold on, you will make 7%. Some years you will make, it'll be in the red. Other years it'll be way above 7, but on average you will make 7%, which means as long as you hold on over the long term, you are going to be making money in the stock market. Now, if you are going to be investing into individual stocks, that is where this concern of losing money in the stock market comes up a little bit more. It's more of a prominent issue. When investing into an index, there's a lot less risk. When investing into an individual company, you very well could choose a company that is not good. It has no future growth to it. And not always, but there are some very safe companies. For instance, I would say that Apple and Microsoft, Amazon, Google, Visa, MasterCard, McDonald's, I feel like all of these are very safe companies that if you invest into just Apple, for instance, it's almost guaranteed that it's going to be a pretty safe investment. I mean, it's well known, it's huge, and it's got a lot of cash on hand. It's not going to go under within a couple months or years or whatever like that. It's a long-term holding company. But there are certain individual companies that if you do invest in, the companies could go downhill and be pretty damn near worthless. For instance, the most recent one that I know is Nikola. Can't think of the ticker symbol, but it was an EV company that had a lot of hype on it, and it was a lot of investors were pouring in. And because they thought it was like the next Tesla or whatever like that. But what ended up happening was that I guess the company had not really told the truth or something like that. I didn't really keep up on it. I never invested in it, but there was a scandal with it or whatever like that, and the stock absolutely plummeted. And for the investors that had invested in Nikola, I'm sure a lot of people, some people lost money with that. So when investing into, I would recommend when investing in new companies, recent IPOs, companies that are not really stable, companies that aren't keeping up with the time. For instance, a lot of nowadays is going into like e-commerce and online stuff. For companies that are not following the growth and not moving with the times, they could see declining revenue, and that could lead to lower share price. And again, that if you own that company, if you own individual companies, your investment could theoretically go to zero if the company goes bankrupt or whatever like that. Recently, again, I think it was Hertz or something like that. That company went bankrupt that I know of. So if you invest in an ETF of, say, the S&P 500 or something like that, you are pretty essentially guaranteed. I would say guaranteed to make money. If you choose individual companies, just know that it's going to require a lot more due diligence on your part to find the proper companies. But if you are looking for, I want to invest in the stock market, but I don't want to lose money, and as long as you're a long-term investor, in ETFs such as the S&P 500, a very common one is like VTI or SPY, is going to be a very good, safe bet for you. So those are the two main reasons. Those are the two main concerns that I hear. If you have any other concerns or questions about, like, if there's anything that's holding you back from investing in the stock market, leave a comment down below and let us know what it is. Those are the two most common ones. Maybe there's others that I'm not aware of, but if there are any others, leave a comment below, and we'll see what the concern is. For those who have conquered your fears now, let's get into the bread and butter of this video. So I'm going to try to break this down as simple as possible. Okay, so the first step, and this is sometimes a step that is out of our control, but if you're watching this video, then it is 100% in your control. And the first step is, if you can start investing, do it now. The earlier you can invest, the more money you'll make in the long term. The sooner you invest, the longer compound interest has to take effect. So, if you have your investments for 10 years, they're not going to grow as much as if you had put still the same amount, but you had left them for 30 years, okay? The more time you have, the more your investments will grow. And that's it. That is simply it. If you can start, first step one is, if you can invest now, invest now. If you can invest tomorrow, invest tomorrow. If you can invest as soon as you get your next paycheck, invest then. The sooner you invest, the better off you'll be. Step two is going to be really just deciding how much you want to invest. This number can be different from person to person. For instance, I invest around $2,000 to $3,000 every single month. However, this number, again, will be different depending on your circumstance. Depending on if you're a college student and you're broke and you have like $5 in your checking account, or if you already have a job and you're like 20-something and you have a good job and you're making $50,000 a year. If you make investing a priority, you probably can figure out within your budget how much can you afford to invest per month, per paycheck, per quarter, whatever time frame you have. You should be able to find some money to invest. Okay. Now, again, that number will be different. Furthermore, this number will also be different based on what your goals for the investment are. If you want to invest to retire with this account, you're probably going to need a lot more money invested than if you're investing money into the stock market just to be in the market and not want to like miss the market or FOMO or whatever like that. Depending on what your goal is, it's going to determine how much you're going to need to invest. So know what your goal for your investments are, and that will help you then work backwards to see how much you need to invest per month. So for instance, if you want to have $100,000 in your portfolio, have $100,000 and then go back in time to see, okay, how much do I have to invest per month to reach $100,000 in like a year or 2 years or whatever it is. So do have that. That's going to be really helpful. When you have a goal for your investments, you will be a lot more driven to meet those goals. If you're just saying, oh, I want to invest, then you're going to be really lazy about investing. You're going to invest once and then 4 months later, you're going to invest again. A very good thing to do is to consistently, no matter what happens, invest in the stock market. So for instance, I get paid every 2 weeks. So every paycheck, I take money and I invest in the stock market. So every 2 weeks, I have gotten used to just taking money automatically out of my paycheck and investing it. If you can get some sort of uniform kind of way of every paycheck I invest $100 out of it. At the first of every month, I invest a little bit. On the 1st and the 15th, whatever it is, find something that will create a schedule for you to invest, and that'll create a habit of investing, and you'll see that your investments grow a lot faster when you have a goal and a schedule of how much you're going to be investing. So next, when thinking about this, make sure that it does fit within your budget. If you have credit card debt, if you have a car loan or whatever like that, try to make sure that you pay that off first, because if, again, on average, stock market returns 7% per year. So that is a good starting point. So if you have any debt that is higher than 7% interest, then pay off that debt first, because you're not going to be making money. If you have like a mortgage and it's like 2 to 3% interest rate, then you probably can still invest in the stock market, because the stock market is going to return 7% on average. But again, figure out what the numbers are. 7% is a good idea. If you have credit card and it's like 24% interest rate, pay off the credit card first, because there's no way you're going to be able to be making up the money by investing in the stock market. Pay off any high interest debt first. Step 3 is going to be the first initial actually investing. So step 3 is going to be opening up a brokerage account. Now, there are dozens of choices out there, and you're going to need to do some of your own research for which one you want to be with. However, I have left some links down below to some of the best ones that I've been with personally. And right off the bat, there's like Robinhood, there's Webull, Charles Schwab, Chase Investments, Merrill Edge. There's a ton of different brokerages. There's a ton of little smaller ones, but find the one that works for you and meets your needs. However, when doing this step, there's only one thing that I ask from you all. Please do this one thing. No matter what happens, do not, and I repeat, do not use a brokerage that has commissions on it, okay? We are past that age. We are past that age in time where having commissions, or paying commissions for investing is over, okay? It used to be a common thing where any bank that you went to, they had commissions. Nowadays, there are tons of places and big name brokerages like Charles Schwab and Fidelity that no longer have commissions. No matter what you do, please do not go to a brokerage with commissions. You're just wasting money, and you're paying the bank to do something that you literally could do for free if you went to a different brokerage. Okay. So next is going to be step 4. And step 4 is going to be where your investing becomes very individual. It's also the easiest and hardest step of investing at all. Step 4 is picking your investments. This is going to mean what ETFs are you going to invest in, what companies are you going to invest in, what bonds you're going to be investing in, what mutual funds. This is where you're going to be picking all of these things. And this is the most individualistic aspect of investing. And it's also going to be the easiest because it's nowadays, I mean, if like you're using Robinhood, for instance, or whatever, it is so easy to type in a random company that you know very well, like Wells Fargo, for instance, and clicking like one share and then just swiping up, poof, done. It is so easy to do that now. However, because it is so easy, there are a lot of difficulties with it. Because again, if you pick an individual stock or mutual fund or whatever, there's no guarantee that you are going to get returns. So you need to pick the best investments. And every investor is different, and so I don't have any stocks right off the bat that I would be like, hey, you need this stock right now. Everything's going to be individualistic. It's going to be depending on your time frame, your risk tolerance, and all that. But what I can do is, if you want a video on how to look for stocks, leave a comment below and hit the like button. So there are ways that you can find companies, and if you want to know how to find certain companies for growth, dividends, or whatever, then again, I can make a video about that if you want me to. So those are really all the steps. Step 5 is congratulations, you are done. You are an investor. From now, step 5 and onwards, step 5 is going to be one additional step, kind of. Step 5 is going to be, what you're going to be doing in step 5 is you're going to be consistently re-looking at your portfolio, whether that's on a monthly basis or whatever. You're going to look back on your portfolio and you're going to see how it's doing. Are there any companies that are undervalued that you can buy? Are there any companies that are starting to become overvalued and you can sell for some profit? Are there companies who you no longer have conviction in? Are there companies that no longer meet your standards? Do they no longer meet your growth potential, your risk tolerance, whatever it is? Step 5, on a monthly basis, quarterly basis, whatever, look through your portfolio and update your holdings. Add new stocks, take away new stocks, add new ETFs, take away new ETFs, whatever it is. Update your portfolio and check on it about every month. I would recommend. This will ensure that you're keeping up with the market and what's going on. You're keeping up with the companies, and if there's any other new holdings that you want to add on a monthly basis, you can add them into your portfolio. At this time, when you're looking at adding or buying or selling new stocks or ETFs, whatever it is, I would also recommend that you rebalance your portfolio. And what that means is basically you don't want one company or one ETF, whatever, to have a lot of weight in your portfolio. It's not necessarily a bad thing, but it can be bad in some instances. So, for instance, my dividend portfolio that you're looking at right now, some of my holdings in this portfolio are overweight compared to the rest of my holdings. But I know that because I check it quite frequently, and I'm okay with the risk for now. But if you are not okay with having one stock make up 60% of your portfolio, then when you check on it on a monthly basis or whatever, this will give you a chance to see if there's other companies that you want to invest in, and if there's profits, take a little bit of profits out and put it into a different company. If you still like the company, maybe move it to a company that's maybe in the same sector. If you're really into like EV and say Tesla is your main holding, but you're starting to get a little concerned about, Tesla, makes up 60% of my portfolio, maybe try moving some of your portfolio out of Tesla and into other EV companies such as NIO, That's the only one that I actually have in mind right now, but like NEO or something like that, just so that you at least get a little bit of diversification, where if one company starts going down, maybe the other one will pick up this slack. So that is going to be really step 5. Rebalance your portfolio, buy and sell positions that you no longer want or need. And as long as you continue doing this, also with step 2, ensuring that you're putting in money into the stock market, you are now slowly going to start building wealth. If you have any other questions, leave them down below in the comments. I know I probably didn't go over anything, but I wanted to keep this as simple as possible. But if you have any questions, leave them in the comments down below. Down below, I've also linked some articles that you can read about how to start investing. Some of these articles are the articles that I used when I first started investing. So they're very good articles. I will leave a link to them all down below. Take a look at them, read them. If there's any questions that you have, again, feel free to comment or email me with any questions that you have. Now that is all it for today. If you like this video, please hit the like button, and if you want more content like this, hit the subscribe button and turn on the notifications so you don't miss any of my videos as they come out. And I will see you all in my next video. You all stay safe, and I will see you all next time. Bye bye.